Conceptual Framework for Financial Reporting, an Integrated and Analytical Study. Introduction, Concept, Historical Development, and Core Importance. The conceptual framework for financial reporting represents the fundamental and intellectual structure upon which the process of preparing financial reports is based, in accordance with International Financial Reporting Standards, IFRS. It is not a standalone accounting standard, but rather a theoretical and constitutional framework that defines the basic interrelated concepts that govern how accounting events and transactions are identified, recorded, measured, and communicated to users. This framework was established to serve three primary purposes. First, to provide a consistent and logical basis for the International Accounting Standards Board, IASB, to develop new standards and review existing ones. Second, to guide preparers of financial statements when developing accounting policies in cases not covered by a specific standard, or when a standard allows for multiple choices. Third, to assist all users, such as investors, auditors, and regulatory bodies, in understanding and interpreting the information contained in the financial statements, as it explains the logical basis behind their preparation and presentation. The development of this framework passed through important stages, beginning with an initial version issued by the International Accounting Standards Committee, IASC, in 1989, under the title Framework for the Preparation and Presentation of Financial Statements. It then underwent fundamental amendments in 2010 after responsibility was transferred to the International Accounting Standards Board, IASB, where it was renamed to reflect a broader focus. The comprehensive revised version of 2018, effective from January 1, 2020, was a qualitative leap, as it added new chapters and modified core concepts, making the current framework consist of an integrated structure of interrelated concepts. 1. The primary objective of financial reporting. The primary objective of general-purpose financial reporting is determined as providing useful financial information to its primary users to make decisions related to providing resources to the entity. The primary users are current and potential investors, lenders, and other creditors. These groups use financial reports in investment decisions, buying/selling/holding, equity and debt instruments, in credit decisions, granting or settling loans, and in assessing management's efficiency, stewardship, and exercising voting rights. To evaluate the entity's ability to generate future cash flows and the efficiency of its management, users need information about a. Economic resources, assets and claims, liabilities and equity, i.e., the financial position. b. Changes in these resources and claims, i.e., financial performance, cash changes, and other changes in equity. The framework emphasizes that the accrual basis of accounting is the best for measuring performance because it reflects the economic impact of transactions when they occur, and not just when cash is received or paid. 2. Qualitative characteristics of useful financial information. These are the attributes that financial information must possess to be useful in decision-making. They are divided into two groups. Fundamental qualitative characteristics. Relevance. The information must be capable of making a difference in the user's decision. This requires the information to have predictive value or confirmatory value. Linked to this concept is materiality, meaning that omitting or misstating the information could influence the user's decision. Faithful representation. The information must neutrally and objectively reflect the economic phenomenon it aims to represent. This is achieved through three attributes: completeness, including all necessary information; neutrality, freedom from bias; and freedom from material error. Accuracy of the production and measurement process. Enhancing qualitative characteristics. These characteristics increase the usefulness of information that already possesses the fundamental characteristics, and they include comparability, across different periods and with other entities; verifiability, the possibility of confirming the accuracy of the information by independents; timeliness, and understandability, presenting information clearly and concisely. These characteristics are subject to the cost constraint, where the benefits of providing information must exceed the cost of preparing and publishing it. 3. Financial statements and the reporting entity. Financial statements refer to a structured representation of financial information, typically consisting of the statement of financial position, the statement of comprehensive income, the statement of cash flows, the statement of changes in equity, and the notes. The statements are prepared on the going concern assumption, unless there is an intention or necessity for liquidation. As for the reporting entity, it is any entity, whether it is a sole proprietorship, part of a company, or a group of companies, that prepares financial statements, whether by law or by choice. 4. Elements of financial statements. The 2018 framework provided improved definitions for the basic elements. Asset. A present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. Liability. A present obligation of the entity to transfer an economic resource as a result of past events, with a focus on the obligation to transfer an economic resource. Equity, the residual interest in the assets of the entity after deducting all its liabilities. Income, increases in assets or decreases in liabilities that result in an increase in equity, excluding contributions from holders of equity claims. Expense, decreases in assets or increases in liabilities that result in a decrease in equity, excluding distributions to holders of equity claims. 5. Recognition and derecognition. Recognition is the process of capturing an item in the financial statements. For recognition to occur, the item must meet the definition of one of the financial statement elements, and its recognition must result in providing useful information, i.e., relevance and faithful representation. Derecognition is the process of removing a previously recognized asset or liability, which occurs when it no longer meets its definition, usually due to the transfer of control over the asset or the settlement of the liability. 6. Measurement. This part addresses how to determine the monetary value of recognized assets and liabilities. The framework describes the main measurement bases without mandating the use of one over the other, leaving the choice to individual standards based on achieving the best balance between relevance and faithful representation. The most important measurement bases are historical cost, the price paid when acquiring the asset or received when the liability was incurred. Current value reflects current market conditions and includes fair value, the price in an orderly transaction, value in use, the present value of future cash flows expected from the use of the asset, and current replacement cost. 7. Presentation and disclosure. Focuses on how to communicate information effectively. Presentation. Organizing, classifying, and arranging items within the primary financial statements themselves, such as grouping current asset items together. Disclosure. Providing additional information in the notes or using other means outside the primary statements. Offsetting between assets and liabilities or income and expenses is prohibited unless it is fair or required by a standard. 8. Concepts of capital and capital maintenance. Discusses the two different ideas of capital and how to maintain it, which affects the definition of profit. Financial capital, measured by the monetary value of net assets, equity. Maintenance means profit is realized only if the value of net assets at the end of the period exceeds their value at the beginning, after excluding owner contributions and distributions. Physical/productive capital, measured by the operating or productive capacity of the entity. Maintenance means profit is realized only if the productive capacity at the end of the period exceeds its capacity at the beginning. The financial capital concept is more widely used in current accounting standards. Conclusion and practical importance. The 2018 revised conceptual framework forms a solid intellectual foundation and a principles-based thinking methodology for the international standards system. Its role is not limited to providing definitions, but rather sets practical guidelines for recognition, measurement, and presentation, which enhances the consistency and reliability of financial information globally. It guides all parties, from the legislator to the accountant to the investor, to make decisions that lead to the production of useful, dependable, and comparable financial information. It is the ultimate reference in the absence of specific guidance and the constitution that ensures the stability of the global financial reporting system. Would you like me to Financial Statements and the Reporting Entity, an Integrated Conceptual Framework. Chapter 3. Financial Statements and the Reporting Entity. As previously mentioned, the primary objective of financial statements is to provide users with financial information about the reporting entity's assets, liabilities, equity, income, and expenses. This information is provided through 1. Statement of financial position, balance sheet, reflects the financial position at a specific date. 2. Statement of financial performance, income statement and other comprehensive income, displays the financial performance over a period of time. 3. Statement of cash flows, shows the sources and uses of cash. 4. Statement of changes in equity. 5. Notes to the financial statements, an integral part of the statements, providing additional details and accounting policies. Together, these statements aim to present and disclose the following: recognized assets, liabilities, income, and expenses, providing information about their nature and associated risks. Unrecognized assets and liabilities, such as contingent assets and liabilities, governed by IAS 37. Cash flows, since net profit does not necessarily reflect the entity's cash health. Contributions from and distributions to owners, to distinguish transactions with owners from operating activities. Methods, assumptions, and estimates used, and any changes therein, because estimation and professional judgment are essential elements in preparing financial statements. Reporting period. Financial statements are prepared for a specific financial period called the reporting period, usually a fiscal year. The statements provide information about the financial position at the end of the period and the financial performance during it. The General Presentation and Disclosure Standard, IAS 1, requires the presentation of comparative information for at least one previous financial period. This helps users to identify trends in the entity's performance and position, Evaluate changes in financial statement items over time, which enhances comparability. Going concern assumption. Financial statements are prepared on the assumption that the reporting entity is a, quote, going concern and will continue its operations for the foreseeable future, with no intention or need to liquidate or cease trading. If indicators arise that cast doubt on the entity's ability to continue, such as recurring losses, serious liquidity problems, or the loss of a major market, IAS 1 requires management to perform a going concern assessment. If management concludes there are material uncertainties, these must be clearly disclosed in the statements, along with the assumptions and policies used. If management decides the entity will not continue, the statements must then be prepared on a liquidation basis, and this fundamental change in basis must be disclosed. The reporting entity. A reporting entity is an economic entity, not necessarily a legal one, that is required or chooses to prepare financial statements. It can be a single entity with no subsidiaries, a part of an entity, such as a branch or division, a group of related or unrelated entities. Relationship with consolidated and combined financial statements. 1. Parent-subsidiary relationship. If entity A controls entity B, according to the definition of control in IFRS 10, the reporting entity is the economic group A plus B, and its statements are called consolidated financial statements. 2. Parent entity alone. If the parent entity prepares its statements without consolidating the subsidiary, they are called unconsolidated or separate financial statements. 3. Aggregation of entities under common ownership. If an owner, such as an individual or investment fund, owns several companies, A, B, C, that do not have a parent-subsidiary relationship and wishes to present their statements together, the result is called combined financial statements. This type is common in private equity reports, or when looking at a group of entities under common control. Chapter 4. The elements of financial statements. These are the fundamental building blocks from which financial statements are constructed: assets, liabilities, equity, income, and expenses. Asset. A present economic resource controlled by the entity as a result of past events. Components of the definition. 1. Economic resource. A right that has the potential to produce economic benefits, such as future cash flows. It is not a requirement that the probability be certain or likely. Its existence is sufficient. Examples of rights: accounts receivable, positive forward contracts, derivatives, prepaid expenses, right-of-use assets, IFRS 16, from leases, and intellectual property. 2. Control. The entity has the current ability to direct the use of the resource and obtain its benefits, and prevent others from doing so. E.g., an entity controls a machine under a finance lease even if it does not legally own it. 3. Past event. Control must have arisen as a result of a past event, such as purchase, production, leasing, or a gift. Liability. A present obligation of the entity to transfer an economic resource, an asset, to another party as a result of past events. Components of the definition. 1. Present obligation. A duty or responsibility that the entity has no practical ability to avoid. It may arise from a contract, law, or even past practice that creates a valid expectation in other parties. Constructive obligation. 2. Transfer of an economic resource. Fulfilling the obligation must lead to an outflow of economic benefits, cash, goods, services. It is sufficient that the obligation is capable of causing this transfer, even if it is not probable. 3. Past event. The event that led to the obligation must have already occurred, such as receiving goods or services, or obtaining a loan. Equity. Equity is the residual interest in the assets of the entity after deducting all its liabilities, expressed by the basic equation. Characteristics of equity. Represents claims on the entity that do not qualify as liabilities. The entity has no present obligation to transfer an economic resource upon claim. Equity arises from owner contributions, capital, retained earnings, accumulated profits not distributed, legal, statutory, or voluntary reserves. Income and expenses. Income. Increases in assets or decreases in liabilities that result in an increase in equity, other than those relating to contributions from owners. It includes revenues. Arise from ordinary activities, sales, services, interest, rent. Gains. Increases in equity that may arise within or outside ordinary activities. Gain on sale of fixed assets, valuation differences. Expenses. Decreases in assets or increases in liabilities that result in a decrease in equity, other than those relating to distributions to owners. It includes operating expenses, salaries, rent, depreciation, losses, such as loss on sale of assets, foreign exchange losses, or derivative valuation losses. Qualitative characteristics of financial information. Fundamental characteristics. 1. Relevance. Information is relevant if it is capable of making a difference in the decisions made by users. It includes predictive value. confirmatory value and materiality. 2. Faithful representation. Information must accurately reflect the economic reality. It is achieved through completeness, neutrality, and being free from error. Enhancing qualitative characteristics. 1. Comparability. Enables users to compare the entity's performance over periods and against other entities. This requires consistency in applying accounting policies. 2. Verifiability. Different knowledgeable and independent observers could reach a consensus that a particular depiction is a faithful representation. 3. Timeliness. Having information available to decision-makers in time to be capable of influencing their decisions. 4. Understandability. Classifying, characterizing, and presenting information clearly and concisely. Cost constraint. The conceptual framework stipulates that the benefits of providing information should justify the costs of collecting and presenting it. General conclusion. The conceptual framework for financial reporting represents the theoretical basis upon which international accounting standards are built. It aims to enhance quality, reliability, consistency, and transparency to support sound economic decision-making. Would you like me